Again, I'm your presenter for today. We'll be starting the session in proper about 7:02 p.m. Let's give some more time for some of our friends to join us. Meanwhile, while you're here, you can take a look at our ongoing promotions to sign up, or if you wish, you can also sign up for a Nova demo account by scanning the QR code. Okay, we'll start soon in about a minute's time. Good evening, everyone. Thank you for joining us again for our live webinar on how to generate passive income with ETFs. This is Phil Gunn. I'm a Senior Sales Manager with Phillip Nova. In today's webinar, we'll be discussing on ETFs and also taking a look at some dividend-paying ETFs. Before we begin, I'd like to do a sound check. If you can hear me, just type yes into the question box. Also, during the webinar, if you have any questions, do type them into the question box and I'll address them during the Q&A session at the very end of the webinar. Okay, it seems like everyone can hear me clearly, so let's begin tonight's webinar. Before that, just a quick introduction of myself. My name is Phil Gunn, the speaker for this webinar, and I've been with Phillip Nova for 15 years now, since 2008. I hold a dual license in futures and stocks, and I'm an account manager to help clients trading in futures, forex, as well as shares with understanding the product and market by providing coaching and economic information to make proper trading decisions. Well, there are numerous ways to generate passive income, and investing in ETF exchange-traded funds may be just the right fit for you. Whether you are just starting on your investment journey or looking to diversify your portfolio, ETFs offer a beginner-friendly approach with the potential for steady returns. Throughout the webinar, once again, if you have questions, just feel free to post them in the question box. My facilitator will arrange them and let me know, and I'll answer them during the webinar at the very end. This webinar will also be put up later on the YouTube after today, so for you to revisit if you have any questions about any parts of the presentation. Okay, let's get right into it. Before we start, a disclaimer on our webinar today. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. On the agenda for today, we'll start out with a brief introduction on what ETFs are and the different types of ETFs. Very much like trading stocks on the exchange, ETFs are investment funds that are traded on stock exchanges. We'll discuss the small differences between trading individual stocks and trading ETFs. Next, we'll go on to decide on what kind of investor you are. Are you looking out for stable returns with more controlled risk exposure? Some ETFs even pay dividends periodically, making them the perfect way to start generating passive income. We also look at the advantages and disadvantages of ETFs and why people use ETFs to trade. After understanding the basics of ETFs, we will look at some popular ETFs with large AUM, assets under management. What is the expense ratio for ETFs and the impact of certain corporations on ETFs? Finally, we'll look at about 9 ETFs that actually pay dividends, and you may consider them into your portfolio. Right, what are ETFs? It is a type of collective investment that holds a basket of underlying assets, which can vary from stocks, bonds, and commodities. It is structured to track the performance of these assets, ranging from a single asset class to a large, diverse collection of securities, for example, the S&P 500 index. By trading on the exchange, you can buy and sell these ETFs at different prices throughout the day during the trading day of the exchange. In contrast to mutual funds, which can only allow execution of once per day trade at a single price at the end of the day. So ETFs gives a lot of convenience in that sense. ETFs, in short, is for exchange traded funds, are investment funds, which can be bought and sold on stock exchanges, similar to like when you buy individual stocks. They are designed to track the performance of a specific index, a commodity like gold, a bond, a government bond, or corporate bonds, or just a basket of assets. ETFs offer investors the possibility to diversify a portfolio of assets and also the flexibility to trade on an exchange during the trading day. Overall, ETFs have become popular investment vehicles due to their transparency, liquidity, and also their cost effectiveness. Next, we'll take a look at the differences between individual stocks and buying an ETF. As you're aware, investing on an individual stock solely invests on one single company. Investing in an ETF comprises of a basket of assets in which the underlying can be either stocks, bonds, real estate, cryptocurrencies, or precious metals. So, in terms of diversification, individual stocks trading actually lack in diversification, resulting in higher volatility, impacting on the returns over time. ETFs solve the diversification issue by having a portfolio that can potentially minimize losses. Well, the cost for investing in ETF and individual stocks, in a sense, individual stocks will lead to a more hefty fee, because if you invest US $100,000, the commission charge for the US stocks is a minimum of 0.01%. That will equate to about $10 for a round trip for a single stock. Consider that if you were to purchase 505 stocks for a diversified portfolio, the cost for trading in this amount of different counters will cost approximately $5,000 US for just a commission fee. Using the ETF allows you to actually own the multiple assets at a lower cost, so you can actually invest in a ETF in a stock index. So using the $100,000, just purchase the ETF, which covers a basket of securities, stocks that's listed on the US exchange, the SPY, for example. And the cost is also $10 USD for a round trip, and that will give you an expense ratio that you have to pay for 0.0945%, which will equate about 94.5. Overall, it's still cheaper than purchasing each of the individual stocks with a fee of only $104.50. So in terms of cost, ETF is more cost effective. In terms of management, that's where the advantages comes in. Individual stocks requires tedious process and management, and you have to balance the portfolio from time to time. While investing in ETF, you have the ETF fund manager that will do this for you, investing with ease without to worry about the performance of each individual company. So the rebalancing is actually done on the fund manager's end, and you do not have to worry about managing the portfolio. So that's the difference between investing using stocks as well as investing using ETFs. Well, let's look at what ETFs can be segregated to two categories. First, passive ETFs and active ETFs. For passive ETFs, it tracks the index by either replicating or purchasing securities that make up the intended index, which provides the most representative sample of the index. While for active ETFs, fund managers will actually rebalance a portfolio as and when he sees the need to do so. Next, ETFs can also be categorized into two categories called the physical as well as synthetic. For physical, it tracks the underlying index by purchasing all the underlying assets listed in that index. For synthetic, it can tap into different products such as the futures market, the derivatives market, to mimic the performance of the underlying index. So basically, ETFs can be categorized into either passive or ETFs or physical and synthetic ETFs. Before I go into ETFs, to decide whether it's suitable for you, you have to decide what kind of investor you are. So are you invested into a certain company or industry? If you are looking at a particular industry, for example, electric vehicles or the tech industry, the choice of simply investing in that stock will actually fulfill your investment profile. However, if you are looking to invest in the overall US market, a good ETF, index ETF, stocks index ETF, will be more suitable for you. So next, do you have time to manage the portfolio? What is your risk exposure? Depending on whether you want to manage the individual stocks in your portfolio or have sufficient funds to even buy every single stock, you can choose to buy individual stocks or simply invest in an ETF that does the work for you. If you have the time to go in for short-term trades, there are speculative ETFs that can focus on higher risk but potentially higher reward investments. These ETFs are designed for investors seeking potentially higher reward and for a more volatile and speculative asset class. It's important to note that while this offers the potential for significant returns, they also come with higher levels of risk and volatility. Next, perhaps you are also considering building a passive income with dividend payouts, but do not have the time to manage all of them. Then you can choose to select some stable ETFs that invest in the industry that you're interested in. This can be, for example, the property sector in REITs, or again, an index ETF. We'll touch on some examples of such stable ETFs at the end of the webinar. Next, let's look at the advantages and disadvantages of ETFs. First, the advantages. Very obvious, the liquidity of ETFs in the market. There's a highly traded ETFs, which we'll be also touching on later, that allows investors to enter and exit positions easily. Liquidity is the foremost important factor to consider when trading in a product, and ETFs has been in the market for many years. While transparency, the portfolio holdings are generally disclosed in the public, and there's prospectus that can show you what are the underlying that they cover. So transparency of the product that I invest in is widely available on the exchange, on the websites as well. Flexibility. Certain ETFs allows you to trade in a bi-directional market, so you can trade in a bull as well as the bear market. Well, coming with this is of course higher risk, but a higher potential return. So this is not for the typical investors for a long-term perspective, but more of a short-term trading opportunity. Most of all, portfolio diversification. So ETFs actually removes the hassle to actually single pick each of the stocks. The fund manager does it for you with a well-balanced portfolio and can reduce unsystematic risk. Lower cost. As touched previously, investing in single stocks can actually incur a high cost, and the cost of ETFs are actually competitive, require a lower capital to invest in a basket of shares to trade as compared to trading on each of the individual stock component under the ETF. Of course, there are certain disadvantages, one of which is the concentration risk. So certain ETFs are dedicated to certain geographical regions, sectors, investment cycles, so you're exposed to a certain sector. Well, that could be an advantage if that's what you're particularly seeking for. Maybe you're looking for a tech sector, then the ETF is suitable for you. Tracking error. So there's a mismatch investment performance with the benchmark and the underlying. Well, this brings up a question if there's a difference in price in the ETFs or the underlying shares that you're trading in. Well, certainly the ETF might not reveal the movements, individual movements of stocks. So there might be a small tracking error between the ETF and the actual stocks underneath. Currency risk. So as in all products, ETFs are denominated in a foreign currency, and this foreign currency, there's an exchange rate risk, which can impact your potential returns when you exchange the money back to your country's currency, in this case, Singapore dollars. All right, let's take a look between ETFs and unit trusts, which are both managed by fund managers. What are the differences between these two types of products? Well, first of all, ETFs offers both active and passive funds, meaning to say the fund manager can actively manage them, or they can just track the index itself or the underlying itself and be passive most of the time. Passive funds are actually lower cost in terms of expense ratio as well. Well, for unit trust, it's also actively managed by the fund manager to ensure the performance. So in this sense, the management style is similar. For the trading style, the ETF can be traded through an exchange throughout the day during the trading hours of the exchange. However, unit trusts can only be traded online through the fund management agent, not through an exchange, or a bank unit trust agent. Trading the price at the very end of the day, only once. So this is a huge difference between trading ETFs where the price is transparent and can be done by yourself online versus doing through one execution of trade per day via a agent bank or a unit trust agent. In terms of flexibility, both covers actually a wide range array of products for you to choose from, different kind of portfolio. So there's no much difference between the ETF and unit trust. For the minimum investment fund amount that you can invest in, ETFs are actually quite flexible on this because just like purchasing shares, you can decide on any amount that you wish to purchase and simply just trade on a per share basis. Well, for unit trust, it's slightly different. You will have to decide on a lump sum of $500 or $1,000 per trade, or there's actually a way where you have to invest $100 per month in order to keep up the investment. So in this way, ETFs actually provide more flexibility in terms of the amount of money you wish to invest. Next, the trading hours. As mentioned, ETFs can only trade within the stock's trading hour on legitimate stock exchange hours. Well, for unit trust, it's actually executed once a day, which is calculated after the market closes on each trading day. Next, the cost structure. The ETF cost structure is very similar to like purchasing shares. So there will be a brokerage fee, a clearing fee, and stamp duty by the exchange. And next, of course, the expense ratio or the annual management fees, which I'll cover on later. For the unit trust, they also have management fees, upfront sales exit fees, but most brokerages will actually waive off all these fees and collect only the management fees. So that brings us to a comparison between the ETFs and unit trusts. Next, we'll move on to discuss on why people trade ETFs. So simply, we have touched on these points earlier on. For its simplicity, ETF provides a great way to attain time efficiency because you do not need to manage your portfolio and you leave it to the fund manager to do so, leaving investors who have less time and a lower barrier of entry to invest in different sectors with a lower level of financial knowledge or research. And in terms of cost effectiveness, it allows you to reduce costs by investing in individual stocks outright, and you can just do so with just investing in the fund, an ETF fund. For diversification, ETFs offer a great way to attain portfolio diversification, and most of all, the liquidity is traded on an exchange. The price is transparent, and you can trade at any time when the exchange is open. All right, we'll take a quick look at what are the popular fund managers. Basically, these are the US fund managers that have been around for, and they are the biggest players ever since. So right here we have State Street, iShares, Vanguard, and Invesco. They have specialty in different underlying assets. But for just to a quick brief on that, State Street, we have the assets under management about 926 billion. We have about 139 ETFs under the portfolio, and also their revenue is about 31 billion. Right. The next popular one is the iShares. This is more for the commodity sectors like the gold. All right. So we also have quite a lot of ETFs offered here, and assets under management is 2.23 trillion. Next, the Vanguard fund manager. All right. So we have the Vanguard, which comes much later. However, the portfolio is also quite big with assets under management of 1.9 trillion and well over 80 ETFs offered. And also we have the Invesco, also one of the major players here with assets under management of 300 over million. So these four fund managers are quite stable and would recommend actually you to pick ETFs from these four types of fund managers. Moving on, we'll look at some popular ETFs under these fund managers. So these have been around for some time. First of all, US equity large cap. So this is basically the US stock index. And we are looking at the SPY or the S&P 500 from State Street, right? This has been in inception since the 1993. And the expense ratio is still under 0.1%. There's a 0.09%, 45%. Right, with assets under management of 426 billion. So this is actually most people would go to if you would like to invest in the overall US stock exchange with an ETF. The SPY would be the one recommended for you. The second choice would of course be a similar choice from Vanguard. which actually was incepted much later at 2010, but also quite a huge assets under management of 300 billion. So these two are with huge liquidity in the market are the widely traded US stock index of the S&P 500 that can look at. Next, we have the bonds, right? The government bonds from iShares that have assets under management of $300 billion. So if you're looking to invest in US government bonds, ETFs, the fund manager, can actually have a portfolio for you to invest in them, right? So for this iShares US Treasury bond, it tracks the ICE US Treasury core bond with a lower credit risk compared to corporate bonds, right? So government bonds are generally safer than buying individual company corporate bonds, which is considered high risk. And the second specific government bond from the US is the long-term 20 years Treasury bond. So this iShares also provide this for $40 billion of assets under management under this iShares model of TLT. Another popular bond ETF that's been traded in the market. Right. This generally will be the recommended one to go to if you are investing in the overall long-term perspective of the US stock climate. And of course, we have the Vanguard that gives you the third option that tracks the Bloomberg US aggregate float adjusted. Right. It comprises mainly investment-grade bonds and has been in inception since 2007. So these are the three major players that are three major products I can look on in terms of long-term bonds. Next, maybe you're not looking at bonds or stock index, but you are actually interested in gold. Well, ETFs is another way you can invest in gold through a fund manager. Well, the most popular one that's traded is the SPDR Gold Trust, or the GLD ticker symbol from State Street. Well, this has been in inception since 2004, and this tracks the spot gold prices from the London Bullion Market Association. So the price that you're familiar with for spot gold price, this can be traded through this SPDR Gold shares price. It will be slightly different from what is showing there, but it tracks the underlying is basically tracking the spot gold prices. The second fund manager that offers the gold price will actually be the iShares fund manager as well. They also have another alternative in comparison to the GLD ticker. So both are actually been around for some time and very popular among people who actually wanted to have a different way of trading in gold besides buying physical gold or actually trading on gold futures. Well, someone more exposed to the energy sector can actually also trade using the State Street, the XLE ticker symbol Energy Select Sector SPDR Fund, which gives exposure to companies in the oil, gas, and consumer fuel, energy equipment, and services industries. Right. Alternatively, if you are specifically trading on the light sweet crude oil, well, this fund from United States Oil Fund LP USO actually mirrors the percentage change in the spot price light sweet crude delivered to Cushing, Oklahoma. So that's for energy. And last but not least, we have the currency, the Invesco DB US Dollar Index Bullish Fund. Well, if it checks the Deutsche Bank Long US Dollar Index relative to the basket of 6 major world currencies, Euro, Yen, Pound, Canadian, and so forth. So, having talked on the major fund managers and some of the widely traded products, let's take a look at the most discussed cost, which is the expense ratio. So what is the expense ratio? Well, expense ratio refers to the percentage of all expenses incurred by a fund when operating, usually expressed in annual units. It includes fund management fees, administrative fees, sales fees, etc. The expense ratio is the cost of managing the fund in short, and investors pay, which is deducted directly from the fund's assets. So you do not have to come up additionally costs to pay for this. This has been already calculated inside the price of the fund itself. So as a result, lower expense ratios are often considered more cost effective. So basically the formula for expense ratio is total expenses divided by the total value of fund assets. So to keep it simple, they express it in a percentage term for you, which is shown to you when you're looking at the prospectus of that fund. So they'll let you know the expense ratio for this ETF is how many percent. Well, usually a passive ETF expense ratio should not be over 1%. So a weighted expense ratio would sit around 0.45%, which is considered a downward trend due to the competitiveness of some similar ETF releases. So an active managed ETF where the fund managers is more actively rebalancing the portfolio will experience a higher percentage expense ratio. However, it also depends on how many products is available on this ETF on this certain sector of industry. So if there's not many choices out there, this can lead to a higher expense ratio as well. So why is this expense ratio important? Well, bottom line is it can potentially eat into your profits in the long run. So looking at this example over here, well, there's a choice of investing whether for the stocks index, US stock index, you can invest in the SPY or the VOO. So the expense ratio for these very similar product but two different trust funds are actually 0.09% for the SPY and 0.03%, which is lower for the VOO. So based on an investment, just for example, of US $1 million, right? You can see that 0.09% brings you $900 and VOO will only require you to have $300 paid, which is incorporated in the price itself. By investing in VOO, you can potentially save up to $600. Of course, this is actually not a very big amount considering the amount of money that you invest in, but well, the bottom line is it does affect your returns on the profits that could come from this investment. So here are some of these resources that I have used for today. If you wish, you can also take a look at them. Next, we'll look at 6 common type of corporate actions that can impact an ETF, right? So similar to investing in stocks, there are also corporate actions that will affect your ETF, right? Very similar. If you're familiar with stock trading, you have heard of dividends, stock splits, consolidation, and so forth, right? Dividends. So we'll have an ex-dividend date as well, and payment will usually be in the form of cash to shareholders instead of sometimes for shares you can actually have scrip dividends, but most of the time for ETFs, investment funds, is in the form of cash, right? Like stock split or stock consolidation, this can increase or decrease the number of ETF units that you hold. But of course, the adjustment of price also comes in on the day of adjustment. Next, liquidation. So when the company liquidates itself or the ETF liquidates itself, it will remove itself from a shareholder's account. So the final payment of cash of the security will distribute to shareholders. Well, the good thing is, which I'll cover later, for liquidation part, the ETF actually you get back the amount of money that you invest in. Instead of the like the shares for companies, which you might, if the company deletes and goes bankrupt, you might not even get back what you actually invest in, right? Next, mergers and acquisitions. Certain ETFs might merge, but the stable ones would probably not change much. You will receive a cash value for the position on the shares in combination or cash or shares if the company finalizes the merger acquisition. So ticker symbol change if there's any change in name. So as you can see, all these are very similar in like investing in shares that will happen to an ETF as well. Next, I was mentioning about the liquidation. What happens if ETFs faces liquidation? Well, first up, investors will not lose any money due to ETF liquidation because the underlying assets of the ETF are still worth their market value. So notification will disseminate into respective shareholders on liquidation, typically within 30 days and the last trading day. So upon liquidation, you can have 2 options. First, to sell your shares before the ETF stops trading, but there's a finite window where you can do so before there's a cutoff time. Next, you can also hold the funds till liquidation. However, the price per share from liquidation may change from the last trading price. So I want to actually advise that if you want to, you probably would want to sell your shares as soon as you can and not wait for the liquidation and determination of the final price. Because in determining the final price, there are also a time period we have to wait for this to happen. And this brings us to the reinvestment risk. During this period of time, there could be market movements in the market, and reinvestment opportunity cause losses due to similar returns in similar market movements. Well, rest assured, all this probably will not happen if you invest into some stable major ETFs. So this is what we'll be discussing on the next part of our webinar now. We'll actually be looking at some ETFs that actually pay dividends, and this can form as your passive income for earning for the significant portfolio. Yeah. All right. So the first one is the Singapore market, which is the Singapore Straits Time Index. The ticker is ES3. Well, this ETF tracks and replicates the performance of the Straits Time Index. This is Singapore's first locally created ETF. It provides investors the opportunity to gain diversified exposure to Singapore's leading companies. So this fund uses a full replication strategy, essentially investing exactly the same stocks as the benchmark STI index, which is physical ETF, right? So the expense ratio is low at 0.3%. The top holdings in this ETF are the Singapore Big Three local banks, DBS, OCBC, UOB. So if you're thinking of investing in banks and unsure of which bank you should invest in, or you do not have so much funds because the price of the individual shares is too high, you can consider this ETF, as this ETF invests in these three banks, as well as the Singapore Telecommunications Singtel. So dividends from these banks will actually form a part of this portfolio, and they are distributed semi-annually from this. And the 12-month yield for this is 4.22%. Well, this is actually one of the most stable ones you can look at if you are actually not interested in US market but want to invest in Singapore dividend paying. The banks are actually the best sector currently, which are doing the best so far. Even in times of COVID, the bank shares have been rising, and to gain access to these dividends, the SBTR Straits Time Index could be a way for you to invest properly in the dividends payings for the sector. This is the price chart for the STI ETF, right? You can see they have been rather stable throughout in a consolidation race. So in terms of risk, in terms of volatility, it's not very high and pretty stable. Next, we'll talk about the US S&P 500 Index ETF, right? I've been talking about the SPY, right? Which tracks the S&P 500 Index. This gives investors exposure to stocks across all the 11 sectors in the S&P 500, so a very broad spectrum of companies. SPY, this ticker, pays dividends on a quarterly basis. Launched back in 1993, SPY was the very first ETF listed in the US and has been around ever since and going bigger. So if you're looking for a really big ETF for the US stock market, this will be the one for you with an expense ratio of 0.0945%. The top holdings include Apple, Microsoft, Amazon, and Nvidia, which forms the bulk of the SPY currently, the tech sector. So with this exposure of about 26% in the tech sector, I would say this portfolio is actually pretty good for people looking at investing in the tech sector of the US market. Well, as you can see, the annual dividend is pretty low at 1.61% for the 12-month yield. But generally speaking, this index is more folly. As you can see from the chart, since 2009, in fact, since way before then, the S&P 500 index has always been on the rise. So in the very long term, this ETF actually brings more returns on the actual fund value itself than the dividends. So for generally speaking, wise until date today, well, of course, with this all-time high, we cannot determine whether there will be a correction in the near future. So I will have to warn against potential risk on any correction in the market, because the price at the moment is at the high of all-time high. Well, that's for the US SPY index, right? For ETF, for bonds, government bonds, next we'll be looking at Singapore government bonds. The A35 ticker symbol. This replicates the iBoxx ABS Singapore Bond Index, which represents the investment returns of Singapore-denominated bonds issued by the Singapore government. And government-linked entities such as excuse me, such as Temasek, HDB, and the LTA, all government bodies, right? So this makes this A35 extremely safe, with Singapore the only Asian country that's been awarded a AAA credit rating for the past 15 years, even through the financial crisis as well as the COVID economic crisis, right, by all three major crediting rating agencies. The fund's total expense ratio is 0.25% per annum, and the 12-month yield is 2.41%. Dividends are distributed semi-annually at the discretion of the manager. Well, meaning to say, it might not be semi-annually, but most of the time it did. As from historical records, did it happen? So historically, this ETF has thrived even during market downturns. During the 2020 COVID-19 pandemic, the ETF actually gained 5.19%, which is up quite a lot, despite the Straits Time Index seeing a decline itself on 16.39% decline. Yeah, so it's a very stable ETF bond. If you are really safe, want to be really safe, well, and currently the price, this is a chart for bonds, is actually at the lower part of this consolidated range, and I would say this is probably a good time to enter, because in terms of when the market, now the market is considered doing well, but in terms of recession, people actually look at bonds for investment for more controlled risk, right? So the price in respect to that, the prices of that will actually start to rise because people come in to pick up bonds, right? And we are actually at the peak of our interest rate decisions. So inversely, the price is also at this low. So technically, this is nothing to be worried about. But we actually poses an opportunity to purchase the ETF for the underlying bond, Singapore government bonds, which is stable, in the hopes of long term to come back to the point of the upper range of this range of the price movement. So I would say this is actually a pretty good opportunity to come into this ETF, and this is a stable bond ETF. Right. That's for Singapore government bonds ETF. Next, we'll move on to the Nikko AMSGD investment grade corporate bond ETF. Well, this is a higher risk ETF. So for those who are actually thinking that all these are we want something more with higher returns and higher risk, well, this MBH ticker symbol sits to replicate the Singapore dollar non-sovereign large cap investment grade index, which tracks the investment returns of Singapore denominated investment grade corporate bonds that are issued by established and credible corporations such as Temasek, such as UOB and HSBC. So although corporate bonds, these three, one of the mains of the underlying, is actually very stable as well. Only investment grade corporate bonds that possess credit rating of AAA to BBB are included in this index. And it has a 4-star Morningstar rating. This fund's total expense ratio is 0.3% per annum. While distributions are made semi-annually, it has a 12-month yield of 3.23%. Compared to a government bond ETF, corporate bond ETFs typically provide higher returns in order to compensate investors for taking an additional risk. The top 5 bond issuers include institutions such as HDB, Temasek Financial, UOB, LTA, and Singapore Airlines. So a pretty solid group there. Well, looking at the chart, once again, bond ETFs is also at the bottom range, and we can see a bottoming bottoming pattern, at the chart. So probably a good time to enter as well in terms of price. Next, we'll look at iShares US Dollar Asia High Yield Bond Index ETF. This ETF tracks the Bloomberg Asia US Dollar denominated High Yield Diversified Credit Index, providing investors with the exposure to dollar-denominated high-yielding bonds issued by governments and corporations in the Asia ex-Japan region. This ticker symbol O9P is best suited for investors that seek higher income and willing to take on additional risk. Another higher risk ETF, but the expense ratio is 0.5%. The 12-month yield is a whopping 7.99%. Around 49.31% of the holdings are BB rated, just to take note of that. Its top issuers include the Industrial and Commercial Bank of China, the Sands China, Win Macau, Bangkok Bank, as well as Vietnam and Pakistan government bonds. So quite a wide range of difference in the previously mentioned bond ETFs. So if you are more wants to have more exposure to these sectors, you can actually consider this ETF because of its potentially much higher yield as compared to others. Well, once again, for bond ETFs, this is also showing some kind of bottoming patterns over here, but has not actually shown a reversal coming up, unlike the others. So it could be another opportunity if you're into picking up cheaper buys. All right, next we'll look at the iShares 20-year Treasury bond, which I've mentioned earlier, the US government bonds or the Treasury bills, right? So this tracks the investment results for this 20 year index, which is composed of US Treasury bonds with maturities over 20 years. It serves as a long duration fixed income play, meaning that the fund is highly sensitive to interest rate changes. Due to the inverse relationship between the bond price and the yield, the fund typically outperforms when interest rates fall. And we know right now we are at the peak of the interest rates. And when the Fed is nearing the end of its rate hike cycle this year, probably by the end of this year, potential rate cuts might creep in, and the decline in treasury yields make longer duration bond ETFs more attractive. Because when the yields drop, the price of the bond itself actually rise. Inversely, relationship within the price and yield. So furthermore, the fund can also serve as a good recession hedge, as the Federal Reserve typically cuts rates during a market crash to stimulate the economy. Unlike individual bonds that are sold by bond brokers, bond ETFs provide investors with greater liquidity, and they are traded on stock exchanges. This ticker symbol TLT also facilitates portfolio diversification. The expense ratio is 0.15%, pretty high for that. But well, for US government bonds, which is another stable sector that you can look at, and we are at a turning point. This, as you can see, the chart prices at the all-time low at the bottom part, so it could give you some potential returns on the actual fund value itself. In the same time, gives you some dividends, right? Something to consider if you think that the reversal is incoming. Next, we have the Phillip S-REIT ETF. Well, ticker symbol CLR. This is actually to replicate the performance of the Morningstar Singapore REIT Yield Focus Index. It is Singapore's first ETF that lets investors invest in high-quality S-REITs screened by Morningstar. The fund provides exposure to income-producing real estate in Singapore and other countries, giving investors a regular income stream. The expense ratio is at 0.6%, while distributions are made semi-annually. The 12-month yield is at 5.3%. So the property sector its holdings include Capital Land Ascendas REIT, Maple Tree Logistic Trust, Fraser's Logistics and Commercial Trust, Keppel DC REIT. So Keppel DC REIT can serve as an AI proxy, as data centers are projected to see higher demand thanks to the exponential growth of technologies such as cloud computing and AI, which require a place to store large data sets that are used for training large language modules. Right, so another to consider for property sector, if you're interested in Singapore market sector, you can choose to invest in this growing popular Phillip S-REIT, right from Phillip himself. Next, all right, also have a look at our charts. This gives you an opportunity to pick up since the price is taking a correction right now. Sorry. So next we will be looking at Nikko AM Straits Trading Asia X Japan REIT ETF. Well, this ETF tracks the FTSE EPRA Nareit Asia X Japan REITs 10% cap index, which covers REITs of countries in Asia, excluding Australia, New Zealand, and Japan. Singapore REITs make up over 70% of this ETF, followed by Hong Kong 14.7%, and then India 5.7%. So again, Federal's decision to pause interest rate as well as optimism they are finished with rates higher is supportive for these REITs with high interest rate environment which translates to higher financing costs and less attractive yield spreads with lower risk bonds. So the total expense ratio is 0.55%. This ETF has one of the most attractive dividend yields on the market, with a 12-month yield of 6.38%. Right. It is the largest REIT ETF listed in Singapore in terms of market cap, and only Singapore REIT ETF, the only Singapore REIT ETF that pays dividends quarterly on a quarterly basis. The top holdings also include Hong Kong-based, as mentioned, Link REIT, CapitaLand Ascendas REIT, and Mapletree Logistics Trust. So a balanced portfolio between Singapore and Hong Kong. However, to take note, the Hong Kong office market is not doing pretty well now. It remains quite challenging with high vacancy levels in the Hong Kong market. This is the chart for the for this ETF. So once again, taking a correction and probably a portion to purchase at a lower price now. All right, we are coming to the end. Just another ETF, the gold ETF. This does not produce any dividends. However, I listed here because some people might be interested in trading gold and they are wondering what may be another separate option to do so. Well, this is actually the SPDR Gold Shares GLD, which is a widely traded gold trust on the exchange, which tracks the price of the gold bullion itself. This is the largest physically backed gold ETF in the world and gives investor exposure to the gold without owning the physical asset, gold itself, gold bars itself. Those transaction costs are typically lower than costs by buying and storing the actual physical gold. And there's also greater liquidity as the funds in the exchange traded exchange and can be traded like stocks. Expense ratio is 0.4%, and with the current gold prices rising high, GLD can help for some portfolio diversification. If you see some more potential for gold prices rise, you can consider this, incorporating this in your portfolio. As in the turmoil, the gold actually performs during financial instability and can be seen as a safe haven, and prices might pose higher if geopolitical tensions arise or the financial markets goes into a recession. So it's the gold price for the SPDR Gold shares at the all-time high in conjunction with the gold price underlying asset. Next, the last one we're looking, I believe, yes, the ProShares Ultra Pro Short QQQ. Okay, this is actually an inverse ETF. Some of you may not have heard of inverse ETFs, but inverse ETF actually poses the opposite direction to the actual direction of the market. So it's a treat. There's also leverage in element in it of a 3 times the daily performance, actually a negative 3 times the daily performance of the NASDAQ 100 index, meaning to say if the NASDAQ index is to rise and you actually buy this, you actually the price will actually fall instead. So this is actually for people who actually want to go against the market. You can actually use the inverse ETF to do so. If you think the market is falling, you can use this with a leverage element. They typically accomplish this via futures derivatives as short positions and swaps. And this ETF is suitable for traders looking to profit from market decline, or you want to hedge your existing positions against a market decline. You can actually use this ETF to do so. Typically, it's advisable to only use for short term, and it is very popular and has been treated as a short-term investment rather than a long-term one. Okay, great. That's the 10 ETFs that I would like to cover that you can consider. We've touched on stable ones, the ones that can pay higher dividends with higher risk, as well as some short-term and a commodity ETF that does not pay any dividend. Moving on, we almost come to the end, but let me just touch on our platform, Phillip Nova, that allows you to trade all these assets in one single platform. So the multiple assets include stocks, ETFs, futures, and Forex. Trade on the go with the Nova trading app on your smartphone, as well as on your PC desktop devices. Enjoy our chart provided by TradingView charts and gain access to over 100 technical indicators. You can also access market depth and view liquidity and trades for a particular price in the market easily. There's no maintenance fees, and you can monitor your trades wherever you are, whenever you want, with our mobile trading app. So sign up for the free live trading account now. It only takes a few minutes. Using your SingPass, you can just sign up, and there's no minimum deposit required. If you sign up using the QR code here, you can also sign up for a free one-to-one coaching session. The course will be on technical analysis, demonstrated with our Phillip Nova platform. I'm a dual license holder specializing in futures, forex, and stocks. You will receive daily updates on economic data releases and technical advice via WhatsApp. On top of all that, our in-house analysts also email technical reports on suggested levels for your reference. This will be on suggested entry and exit levels for your consideration. You'll be sent via daily trading highlights, showing the directional views from the global research desk of our Trading Trees Central. This can be a starting point for your own research to identify opportunities that make sense for you. Markets include Dow Jones, Nasdaq, S&P 500, Nikkei 225, Singapore China A50, Singapore MSCI, the crude oil, and Hang Seng, gold and silver. So we also have daily asset commentaries. For the fundamental side, we have it covered for you with commentary reports to give you updates on the economic news happening around the world. This will keep you updated on the latest economic news that might have a potential impact on the markets, saving you the work of researching it yourself on the internet. Hence, we provide both the fundamental and the technical aspects of trading information to you, and you can have a platform ready to enter the market whenever you are ready. Besides the analyst reports, you can also reach out to me with technical views on the trades as well. I'd like to share with you the promotion right now. If you sign up today, actually, this promotion goes on every month till June. You will get $100 SGD credited as trading account credits into your account when you open one and fund the account. So simply, you can be among the first 50 every month to open an account and then deposit 500 Singapore dollars, then place any trade on any asset class of any size, and you will receive the full trading credits of $100 in the following month. So it's a very simple process. Open an account, fund an account for $500, place any trade, and you'll get $100 credited into the trading account. So simply just sign up for the free account by scanning the QR code over here. When you send this QR code, I'll be your servicing AE that will be assisting you on your trading account matters. So there's no additional cost for this service, so not to worry. You can actually just also open an account first and decide to trade later. There's no funding required at the forefront, and you can take this opportunity of the promotion and also sign up. If you wish to participate in the promotion, you can also fund an account. There are absolutely no maintenance fees or any platform fees. So by using this QR code, I'll be the ones assisting you on your account matters, and you will have a dedicated AE as mentioned on your trading account. I look forward to onboard you on this trading journey. So thank you for your time, and we have almost come to the end. Before that, let's look at some questions and answers, Q&A session. Let's try to answer some questions. All right, so I have a question regarding the ETF from Lei earlier on. He asked about how to pack shares into a basket of ETFs and if there's any space for arbitrage. Okay, regarding this question, I believe you have not attended the webinar. After attending, you will realize that ETFs are actually managed by fund managers, so you cannot actually pack the shares yourself. So it's already determined beforehand. And in terms of arbitrage, I would say it would be quite challenging because the underlying might not be the one that you're particularly looking at. And also, ETFs is more seen as a tool for a diversified portfolio, giving ease and convenience for you not to have to do the work of rebalancing the portfolio. So in terms of arbitraging with the expense ratio, I would think it would be quite challenging, and it's more suitable for ETF, more suitable for long-term investing, dollar cost averaging, that kind of thing. Yeah, so I hope that answers the question. Next, we see a question from Nagesh. Can you share this PowerPoint slides? No problem, because we actually have this live telecast going on forward, but we can also reach out to you, or you can email me for the coaching session also. Yeah, no obligation. You can just post any questions you want as well during the session. Any charges for the coaching services? Yes, it's absolutely free. So you can actually come, it's conducted via online, or you can also come to our office if you wish to meet in person. And the coaching is basically on the platform, as well as a technical uh, perspective on how I view the charts and certain discussion of products. So it's absolutely free. Just feel free to sign up, and then I'll show you the QR code at the next slide. Is there a demo account, and is it free? Is there a platform fee? So as compared to other brokerage houses out there that are actually charging a platform fee, this account is actually free to open. There's no platform fees at all. So you can simply just open without any risk and decide and get access to this platform with different products and live prices. And I have a dedicated person like myself to service you. So of course, if you wish to participate in the $100 promotion, you can do so by just funding and just simply placing a simple trade. And the demo account is shown here, the QR code. You can scan on the left. If you wish to open an account now, you can scan the QR code on the extreme right. So is this available to Malaysian? Yes, of course. If you have a Singapore local bank account, and this is also available to Malaysians as well as foreigners. Yeah. So typically, if you already have a Singapore bank account, it will be very easy to pass the background checks and everything. So just foreigners can also scan this open account by scanning this QR code over here, and I'll get in touch with you for this. We have Malaysia accounts that actually open with us as well. So from Ryan, do Phillip Noah can trade XOXL? I believe you're talking about yes, we have the sticker from the US, the leverage one. So another short term, just now we talk about the inverse. This is actually the bull one. Yes, you can actually trade this on our platform. So just sign up, and we'll sign you. Can ask you to sign up for this US ETFs and US stocks as well. Because during the sign up account, you just need to declare that you are doing US shares by using the W8 pen form, and typically that's what we do. They just give you the access to US shares straight up, and you'll be able to see the price on the platform. So just one last, is there any other questions? We have now come to the end of the session. So if you require any demo accounts, just scan the QR code. If not, if you have been thinking of opening an account, a free account opening, and a person to help you with your trading matters, just open an account by scanning the QR code, and I'll get in touch with you. So this is my contact details. If you wish to have a coaching session that's free, you can also scan this QR code over here. And this is about all the time we have for today. So feel free to drop me a message or email if you have any queries. Thank you so much for being a wonderful audience, and the link of this recording will be posted later on via email tomorrow. If you have any queries about the webinar, you can just to get started, you can just simply reply to the email, and I'll get in touch with you. So this is Phil Gunn signing off. Thank you, and have a good evening ahead.